Welcome back, everybody, to another deep dive. This time we're going to be cracking open Morgan Housel's The Psychology of Money, and in particular, Chapter 12, Surprise.
Ooh, surprise.
Yeah, right. So this chapter is all about why history can be a misleading and even dangerous tool when it comes to planning for the future, especially with our money.
Okay, so we're going to dive into why looking back to plan ahead can backfire.
Yeah, exactly.
I like that.
All right, so let's jump right in here.
Okay.
You want to kick us off?
Sure. So Housel starts off by talking about what he calls the historians as prophets fallacy. And he says it's kind of ironic, right? Because history is literally the study of change.
Right.
But we use it all the time to try to predict what's going to happen next.
Yeah, it's like we're trying to find the unchanging element in a thing that is all about change.
Exactly.
So are you saying that looking back to plan ahead is a trap?
Well, it can be. And Housel quotes a Stanford professor named Scott Sagan who says, things that have never happened before happen all the time.
That's pretty profound.
Yeah, and I think about it like if geologists only relied on what happened in the past, they'd miss out on understanding earthquakes and volcanic eruptions.
Right.
Or doctors would never be able to treat new diseases.
Oh, that's a good point.
Yeah, so it's really about acknowledging that change is a constant. And we can't always predict what's going to come next.
Okay, but how does this apply to like me and my money? How does this actually affect my investments?
Okay, so imagine you're a physicist and you're trying to understand how electrons behave, but you've only ever observed a handful of them.
Okay.
So you're basing your entire understanding of this incredibly complex thing on this very, very limited data set.
Right.
That's essentially what we're doing when we try to predict the future of the financial markets based only on what's happened in the past.
So we're looking at a tiny slice of history and trying to extrapolate that to like the entire future.
Exactly. And there's this great quote from Richard Feynman that I love.
Okay.
He said, imagine how much harder physics would be if electrons had feelings. And Housel uses this quote to illustrate the point that even in something as seemingly predictable as physics, you can't always rely on past behavior to predict future actions.
Okay, that's a great analogy.
Right.
So we can't treat the markets like a simple physics equation.
No, definitely not.
Because there are all these human elements and emotions that come into play.
Exactly. Emotions like fear and greed, they drive a lot of the decisions that people make in the markets. And those emotions, they're not always rational.
Right, so it's not as simple as just looking at the numbers.
Yeah, there's a lot more going on under the surface.
Okay, so we've talked about how historical data can be limited, but what about personal experience?
Yeah.
Like we've all had those moments where we think, oh, I've seen this before,
Yeah.
especially when it comes to our finances.
Right.
So doesn't that count for something?
Well, Housel addresses that too, and he quotes an investor named Bill Bonner, who describes Mr. Market as this guy wearing a capitalism at work t-shirt but carrying a sledgehammer.
Oh.
Right? The point being, things in finance are constantly changing.
And what worked for you in the past may not work now, and what's happening now might not be the same in the future.
So you're saying even if I think I've got this because I went through the dot-com bubble or the housing crisis, that doesn't necessarily mean I'm prepared for the next big market event.
Exactly. And, you might have friends or family members who sold all their stocks during the last recession.
Yeah, man, a few.
And they're kicking themselves now because the market rebounded so quickly. But their experience, while valid, it doesn't necessarily dictate what will happen in the next recession.
Okay, so you're saying we can't rely solely on personal experience either.
Right. It can be a valuable tool, but it's important to take it with a grain of salt. And remember that the market is always evolving.
So we have to adapt with it.
Exactly.
Okay, so now we know that relying too much on historical data or personal experience can be a problem.
Yes.
So what are some of the specific pitfalls that Housel talks about?
Well, he highlights two major ones.
The first one is missing what he calls outlier events. So those big, unexpected things that can really shake things up.
So like the pandemic.
Yeah, exactly. Or like the fall of the Berlin Wall.
Oh, wow, yeah.
These are events that no one really saw coming, but they had a huge impact on the world.
So how do we account for those kinds of events if they're, by definition, unpredictable?
That's the challenge, right? We can't predict them, but we can be aware that they're possible. And Housel uses this thought experiment to illustrate this point.
Okay.
He says, imagine if you tried to understand the 20th century without considering people like Hitler or Stalin.
Oh, wow.
Right. Or what if we tried to understand the 21st century without considering the internet?
It'd be a completely different picture.
Exactly.
We wouldn't even recognize the world.
Right. And that's what Housel is getting at. These outlier events, they might be rare, but they have a disproportionate impact on the course of history.
So it's almost like those events the ones that really define the era.
Yes, and that makes it nearly impossible to predict the future based on the past because you never know when the next big outlier event is going to happen.
So are you saying we can't just look at the past and assume we've seen the worst or the best that can happen?
Precisely.
Okay, so that's the first pitfall, missing the outlier events.
Right.
What's the second one?
Okay, so the second pitfall that Housel talks about is that history often fails to account for massive changes that happen over time.
Oh, okay, I see what you mean.
Yeah, like think about it. We have things like 401ks and Roth IRAs now.
Right.
Those are relatively new inventions compared to the overall history of investing.
Yeah.
The rise of venture capital, the S&P 500, even the internet itself. All of these things have completely changed the way we invest and think about money.
So the financial landscape is constantly shifting.
Yes, and history doesn't always capture that.
So how are we supposed to make smart financial decisions if we can't completely trust our own experiences or even rely on what's happened in the past?
It's a good question, and honestly, it can feel a little overwhelming.
It does.
Right. But I think the key takeaway here is that we need to be aware of the limitations of history and be willing to adapt as the world changes around us.
So it's less about having all the answers and more about being open to new information and new ways of thinking.
Exactly, and that's something that we're going to explore more in the next part of this deep dive.
Okay, so stay tuned for that.
Yes.
We're going to delve deeper into how to navigate this ever-changing financial landscape and how to make smart decisions even when the future is uncertain.
Sounds good.
All right, so everyone, make sure to come back for part 2 of this deep dive.
Yes.
We'll pick up right where we left off.
Looking forward to it.
Me too. All right, we'll see you soon.
See you soon.
All right, so we're back. And we've been talking about how historical data and even our own experiences can sometimes lead us astray when it comes to making financial decisions.
Right. It's not about throwing history out the window completely, but it's about understanding its limitations.
Yeah, so if we're not supposed to just copy what worked in the past, how do we actually use history to our advantage? Like, what can we learn from it?
Well, Housel suggests that instead of focusing on specific events or trends, we should try to see the bigger picture. It's about understanding the underlying patterns of human behavior, especially when it comes to things like greed, fear, and how people react to stress.
So you're saying that human nature is more predictable than the market itself?
In a way, yes, think about it. We can't always anticipate what's going to happen in the market, but we can often get a pretty good idea of how people will react to it.
Right, because people tend to repeat the same mistakes over and over again.
Exactly, and that can be really valuable when it comes to making investment decisions.
Okay, so how do we learn to recognize those patterns of behavior without getting bogged down in specific historical events?
One way is to look at historical events as case studies in human psychology, like take the Fukushima nuclear reactor disaster in 2011.
Oh, wow.
That was a tragedy that no one could have predicted, and it really highlighted the limitations of risk assessments that were based solely on historical data.
So it was a complete outlier.
Exactly, and it really shook things up in the nuclear industry and beyond.
I remember that it was a huge wake-up call for a lot of people.
It was. And it really showed us that we can't always rely on past events to predict future risks.
That makes me think of Nassim Taleb's concept of black swan events from his book Fooled by Randomness.
Yes, that's a perfect connection. Taleb argues that we tend to underestimate the role of chance and randomness in our lives.
Right, we like to think we have more control than we actually do.
Exactly, and that's especially true when it comes to finance. We like to think we can control everything, but sometimes things just happen.
It's like that Mike Tyson quote. Everyone has a plan until they get punched in the face.
Uh-huh. I like that one.
Right. So if we can't rely on history to predict the future, what's the alternative? How do we make financial decisions in a world where surprises are inevitable?
Well, instead of trying to control the uncontrollable house fertile, suggests that we focus on building resilience.
Okay, so how do we do that?
It's about acknowledging that we don't have all the answers and preparing for a wide range of possibilities.
So it's less about finding the perfect investment strategy and more about having a plan that can handle the unexpected.
Precisely. And that might mean having a margin of safety in your investments,
Okay.
diversifying your portfolio, and maybe most importantly, being mentally prepared for those inevitable ups and downs.
It's like that saying, hope for the best, but prepare for the worst.
Exactly.
But how do we actually put that into practice? It's easy to say, be prepared, but it can be tough to actually do it, especially when it comes to our money.
Right. It can feel really daunting, but I think it starts with accepting that uncertainty is a fundamental aspect of investing. We can't control everything, but we can control how we react to things.
So it's about managing our emotions as much as managing our money.
Absolutely. And that's where history can actually be helpful.
Okay, so how does that work?
Not by giving us specific answers, but by helping us understand the broader forces that shape markets and economies. It's about learning from the mistakes of the past, recognizing patterns of human behavior, and developing a framework for making sound financial decisions.
So it's about using history as a guide, not a rule book.
Exactly. Think of it this way. History doesn't repeat itself, but it often rhymes.
Oh, I like that.
We can use those rhymes to guide us, but we need to be ready for the remix.
So we have to stay adaptable.
Right, because the market is always changing and evolving.
And the best investors are the ones who can adapt with it.
Exactly. They're the ones who can learn from the past, but also stay open to the future.
That makes sense.
And that's really what we're trying to do in this deep dive. We're trying to give you the tools and the knowledge you need to navigate the financial world with confidence, even when things are uncertain.
So it's about empowering ourselves to make smart decisions no matter what the market throws our way.
Exactly. And that's a powerful thing.
It is, and it's something that we can all benefit from.
Absolutely.
Okay, so we've talked about how to use history to our advantage and how to build resilience in the face of uncertainty. But there's still one big question that I have.
Okay, what's that?
How do we actually apply all of this to our own financial lives?
That's a great question, and that's what we're going to dive into next.
All right, so stay tuned for part 3.
Yes, we'll get into the practical steps you can take to create a financial plan that's built to last.
Okay, everyone make sure to come back for that.
It's going to be good.
Okay, so it sounds like the key takeaway here is to find that balance between respecting historical knowledge and staying flexible.
Yeah, absolutely. We got to use history to inform our decisions, but not let it totally dictate them.
Right. So be aware of the patterns, but be open to the fact that things are always changing.
Exactly. And that's where things get interesting.
Okay, so how can we cultivate that mindset of adaptability? Like, it's easy to say, be prepared for anything.
Right.
But what does that actually look like in terms of managing my money?
Okay, so that's a great question. And I think it comes down to a few key principles.
Okay.
The first one is humility.
Humility. Okay, so like not getting too cocky when things are going well in the market.
Well, that's part of it, yeah. But it's also about recognizing that we just don't have all the answers. You know, the financial world, it's complex and it's unpredictable, and no one has a crystal ball.
Yeah, I think that's tough for a lot of people to accept, especially when it comes to money.
Yeah, I get that.
Like everyone wants that hot tip or that foolproof strategy.
Right, and it's so tempting to believe those people who sound super confident and certain.
Oh, yeah, totally.
But honestly, the more certain someone sounds, the more skeptical you should be.
That's good advice.
So yeah, humility is step one.
Okay, so what else can we do to embrace the surprise, so to speak?
I think staying curious is crucial. The world is constantly changing, and the more you learn, the more you'll be able to adapt.
Okay.
So don't just follow the headlines, you know. Dig deeper, explore different perspectives, and challenge your own assumptions.
So be a lifelong student of the market, even when you think you have it all figured out.
Exactly.
Got it.
And then finally, I'd say be flexible. Don't get so attached to your plans or your portfolio that you can't adjust when things change.
Yeah, that makes sense.
You got to be able to roll with the punches.
Okay, well, this deep dive has really made me rethink how I approach my own finances.
I'm glad to hear that.
What's the one thing you hope our listeners take away from this conversation?
I hope they come away with a renewed appreciation for the power of surprise, not as something to be feared, but as an opportunity for growth and learning.
That's a great perspective.
Yeah, and by embracing uncertainty, you know, staying humble, curious, and flexible, we can all not just navigate the unexpected, but thrive in a world where change is constant.
That's a great note to end on.
Yeah.
Well, thanks for joining us for this deep dive into the surprising world of financial psychology. Remember, history might not repeat itself, but it often rhymes. So stay tuned to those rhymes, but always be ready for a remix.
Well said. I'll see you next time.
All right, everyone, thanks for listening, and we'll see you on the next deep dive.